Before diving in and knowing how does it operate, we have to know key concepts and key issues. In stock market, there are primary and secondary market. Primary market is whereby a firm sells equity or sells wants to acquire fund through private investor. What do I mean? For instance, you have your company, you seek for investor A, B, C. They invest directly from your firm. So these are primary market. And secondary market, when the company is listed in the public and they wish to acquire more funds, this in order to be listed must be passed through the initial public offering. After listed in the public, the company can stop its trade for a certain price. So in secondary market, for instance, you have a stock worth of $10 that has risen for $15. You wish to sell so as to acquire the profit of $5. You have to find a person who wishes to buy the stock in the same company with the same amount of money required. So if you sold for $15, you have to find a person who also wants to buy your stock for $15. So the difference between the primary market and the secondary market, primary market mostly act directly with the company, private investor, but in secondary, investors tend to buy and sell company along, but they are inclusive in making votes on the operation of the firm. Mind you that. And which this goes in the two types of shareholders of stock. There are common shareholders and there are preference shareholders. These common shareholders are shares that hold majority of vote. They can vote on the operation of the firm. Their say majority is a decision, and their return is not fixed. It depends on the required situation. If the firm has done well, the dividend will increase obviously, but if the firm does not do well, the dividend will be low. They share those, so they share the value of voting and explanation increase of return as the firm goes good. But in preference, they act like certain borrows, which means that the return are fixed. It depends whether you did do well or you did well. So if you did well, if the percentage was 10% return, the dividend will be 10%. But if the company did not did well, the percentage will be also 10%. But preference shareholders, they do not have right to vote. They have not. They do not have the majority rule. But one benefit of the preference shareholder that, for instance, when the company is winding up, after completing all debts, preference shareholders are benefited first. They are paid their own debts and then follow the common shareholders. So it's like a weighing factor that common shareholders have votes and their return can increase or decrease in accordance with the situation, and while in preference shareholder they do not have voting right and the return is fixed. So if the firm has done good beyond the return, so they do not benefit the more return. And when winding up, it usually do rarely occur. The previous shareholder are the first to be considered before the common shareholder.